Hi, this is Lara at Elliott Wave Stock Market with your weekly analysis for Apple done after market close for Monday 5th of August. I'm recording this video now just gone 1:30 in the morning New York time, Tuesday the 6th. I'm closing the comments section on this video on my YouTube channel and all future videos because I do not spend hours of my time preparing and publishing free analysis to then be expected to engage with rude and aggressive comments on YouTube. I'm very happy if you disagree with my wave count, that's fine. I'm happy to answer questions about my wave count, to look at alternatives, and that can be done on my website where I have a very clear comments policy which insists on good manners. I think there are far too many bad manners online. I have two monthly wave counts for you, and the biggest difference between them is whether we view the monthly chart on an arithmetic or a logarithmic scale. I tend to think, particularly for this upwards movement here, it's best viewed on a semi-log or logarithmic scale, which is what my second wave count looks at. But the first wave count has slightly better Fibonacci ratios. It also has some problems. So at this stage, I don't favour one or the other. They're both expecting, at least in the midterm, some more downwards movement anyway, so there's not too much difference in the short to midterm expectation. If we view this on a arithmetic scale, then the first thing that jumps out is we have a long impulse, probably over here, because when we draw a channel around it and we get some great ratios here, then we have a really clear, strong trend channel breach, which should indicate the impulse is over and the next movement is underway. Prior to this channel breach, we only have the odd little overshoot, not a proper clear breach. If we have a 5-wave impulse over here, it's probably at supercycle degree because it lasted decades, 30 years. Cycle wave 3 here is 44.53 short of 2.618, the length of the first wave, and the fifth wave is 16.08 short of equality with the first. The difference between the first and third waves is less than a 10% variation, it's just over 7%. I consider any variation from a perfect Fibonacci ratio less than 10% to be acceptable. Within cycle wave 3, primary wave 3 is 14.15 longer than 1.618, the length of primary 1, and primary 5 has no ratio to 1 or 3. Within primary wave 3, intermediate wave 3 is 9.98 short of 2.618, the length of intermediate wave 1, and intermediate wave 5 is 4.72 short of 0.382, the length of intermediate wave 3. Within intermediate wave 3, minor wave 3 is 29 cents short of 1.618, the length of minor 1, and minor 5 typically has no ratio to 1 or 3. I say that's typical because when you see a good ratio between the first and third wave, the fifth wave often does not have a nice ratio to either of those. The biggest problem with this wave count at the monthly chart level is the brevity of this fourth wave at cycle degree and this fifth wave at cycle degree. Those expectations for how long different wave degrees should last really do need to be quite flexible though. They're just a rough guideline, they're not definitive. We have to understand that there must be flexibility in wave durations and lengths because within an impulse between 1, 3 and 5, you're going to have probably one or maybe two of those extended, and the one that's not extended is often going to be a lot shorter in duration. Within an impulse between the corrective waves 2 and 4, one of them's often a zigzag, and zigzags tend to be very brief. The other's often a combination, sometimes a triangle or a flat, and particularly combinations are very time consuming, that's their purpose. So you're often going to have a problem of proportion between second and fourth waves as well. We have to allow for that flexibility in our expectations of how long waves should last. And having said that though, I do think that 1 month for a cycle degree fourth wave and 4 months for a cycle degree fifth wave really is pushing that flexibility to the extreme, and for that reason I have doubts about this wave count. That's why I'm considering the second wave count. Let's have a look at this on the weekly chart where the start of it here is this point here. I'm seeing this as a complete 5-wave impulse and I wouldn't want to see this any other way. This is a brief zigzag. From this high to this low we have a nice complete 5-wave impulse again. The third wave here showing an increase in momentum is using MACD as an indicator, beyond that seen for the first wave. Here on the weekly and monthly chart we see that. The third wave here is just a bit shorter than the first wave, which means the fifth wave, if it begins here, is limited to no longer than equality with the third, because the third wave may never be the shortest. That maximum is achieved at 295.42. At 362, primary wave 5 would reach 0.618, the length of primary wave 3. If primary 4 moves any higher, then this target and maximum point will have to move correspondingly higher, and the channel will have to be redrawn. Draw this channel using Elliott's second technique from 2 to 4 with a copy on 3. We have the problem of proportion that I've just outlined here. We have a fourth wave, regular flat probably, with a triangle in the middle. The purpose of triangles is to take up time and move price sideways, and that's certainly what this one probably did, if indeed this is a triangle here. Either way, we've got a lot of really choppy overlapping sideways movements, so we've got some kind of correction in here, probably either over here or really close to it. And if this is a flat with a triangle in the middle, you'd expect it to be longer lasting than a zigzag. Let's have a look at this structure on the daily chart, where the start of 3 here is this point here. So here's the brief zigzag, and here's a 5, 3, 5, 3, 5, an impulse down here, probably complete, and all the sideways movement subdivides best as 3 wave structures. We have a 3 up here for an A wave of a flat correction. When we have a flat, the A wave must subdivide to a 3, and the B wave must be at least 90% the length of the A wave. This is 101% at this low here, and that's the orthodox length, not the maximum price extreme. So the B wave subdivides as the triangle is classified as a 3, it subdivides as a corrective structure, and all of these subdivisions within this movement here subdivide best as 3 wave structures. So I'm quite happy seeing a triangle where the E wave falls well short of the AC trend line. You'd usually expect the E wave to either undershoot or overshoot the AC trend line, and this one undershoots. If this is where intermediate wave C begins, then so far it's just passed slightly longer than equality with intermediate wave A. There is not enough downwards movement on the hourly chart at the end of Monday's session to confirm that the final fifth wave within it is not going to continue a bit higher. So if primary 4 does move higher, it may not move into primary wave 1 price territory. Movement above 505.75 would invalidate this first wave count, and that would confirm the second. If we look at the monthly chart, particularly this last piece of the long upwards movement on a semi-log scale, then we see that this current corrective structure looks more in proportion to this piece of movement here, and so it looks possible that we're in a fourth wave correction at cycle degree rather than a second wave correction at supercycle degree. If we see the end of a cycle degree third wave here, we've now eliminated the problem that the first wave count has of the very brief fourth and fifth waves at cycle degree. But in doing that, we've removed the Fibonacci ratio. There's no ratio now between cycle waves 1 and 3. If that's the case, I'd expect to see a ratio for the fifth wave and either the first or third, but we're not there yet. We also have not quite as good Fibonacci ratios within cycle wave 3 now. Primary wave 3 is 10.31 longer than 1.618, the length of primary 1, slightly better than the first. Primary 5 is 8.86 short of 2.618, the length of the first. Again, that's better than the first wave count, but that's where it ends. Within primary wave 3, intermediate wave 3 is the same, 9.98 short of 2.618, the length of intermediate wave 1. But now we lose the ratio between intermediate wave 5. It has no ratio here between 5 and either 3 or 1. Within intermediate wave 3, minor 3 is still 29 cents short of 1.618, the length of minor 1. And the fifth wave still has no ratio to the first or third. Let's have a look at the structure of this possible fourth wave correction, which can't move back into wave 1 price territory. If we were to see movement below 202.96, the idea that this is a fourth wave correction would be invalidated, and the first wave count seeing it as a longer lasting and deeper second wave correction would be confirmed. This is the start of this possible fourth wave, and the subdivisions on the daily chart would still be the same. 5-wave impulse here for an A wave, a 3-wave zigzag for a B wave, and a 5-wave impulse for a C wave. ABC subdivides exactly the same as 1, 2, 3. If this is a zigzag, then it should be over here. I'm not going to go back to my idea I was looking at last week of a possible ending diagonal with a truncated fifth. I don't think that really had such a good look, and I wasn't very confident of that last week. If we have a 5-3-5 zigzag over here, then we're probably looking at a double zigzag for a big fourth wave correction, because if it can't be over here for a couple of reasons. It would be too brief for a cycle degree fourth wave, so that would have that problem, same as the first wave count. But if cycle wave 5 began here, no second wave correction within it may move beyond the start of the first, so this cannot be the start of a final fifth wave here. And like I said, I don't want to put the low of wave W or cycle wave 4 down here. So I'm seeing the subdivisions of this movement exactly the same, a 3 triangle and a 5 up for a flat correction, but instead of a fourth wave this may be an X wave joining the two structures of a double zigzag. It would most likely be a double zigzag unless we see a lot more upwards movement for this X wave, and then we could also consider the possibility that this big fourth wave could also be a double combination. You'd expect the X wave to be a lot deeper for that, or maybe a flat correction if the upwards movement were to reach 90% the length of this downwards movement here. So I'm considering those ideas also on this second wave count chart, but I'm not going to chart them just to try and keep it briefer. There isn't usually a Fibonacci ratio between W and Y of double zigzags or combinations, so we have to wait until we have A and B within the second structure complete in order to use the ratio between A and C to calculate a target. But this would most likely be a double zigzag because at this point the correction may not be deep enough. We need a second zigzag to reach down to the lower end of that channel on the monthly chart with the semi-log scale. And so a zigzag would do that, and the purpose of double zigzags is to deepen a correction. If we were to see movement above 505.75, then the idea that we've got a 5-wave impulse unfolding to the downside would be invalid, and we'd have to consider a double zigzag as this wave count's outlining. Also, we'd have to consider a double combination or a flat correction. That's all for me with your Apple analysis, and I hope everyone had a fabulous week.